Newmont is a leading mining company primarily engaged in the exploration, development, and production of gold and copper. They operate mines in various countries worldwide, extracting these valuable metals from the earth. Newmont is involved in the ongoing exploration efforts to discover and develop new mineral resources to sustain their business in the long term. Due to the recent decline in gold price, Newmont has seen very poor price performance this year, with the stock being down almost 30% year to date. If we then look at the longer time frame, we can see that Newmont is up around 20% in the past 5 years, which is underperforming the major indices by quite a big margin. Now let's move over to QuantView, our stock insight tool, to get a broader insight into how Newmont is performing. And as we can see here, the revenue has been in a slow but steady uptrend in the past 10 years. This trend, however, is something that we don't see in the free cash flow numbers. This is because Newmont is very reliant on the commodity prices, especially the one for gold. This causes them to have sometimes really good years, but also really bad ones, a true cyclical business. This is something we can see right away looking at their net income and earnings per share as well, where they post losses in some years, but also great profits in the others. The dividends that Newmont pays out are also directly tied to this. What I like about Newmont is their ability to have plenty of cash on their balance sheet, almost covering all of their long-term debt. This is especially noticeable when we look at the debt to EBITDA ratio, which has never been above our preferred ceiling ratio of 3.5 times. Very solid. Looking at the share-based compensation, it is tiny compared to the operating cash flow, which is something we really like to see. This shows that the management is not filling their own pockets with stock while the company is barely able to generate cash flows. Cash flows are something we'll take a closer look at in the next segment of today's video. And by the way, if you want to get access to the stock insight tool and all of the valuation models that we'll be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, in today's video we will be taking a 3-step approach to thoroughly evaluate Newmont and determine its fair value. Step 1. Margin of safety. In this step, we'll assess Newmont's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here we'll delve into Newmont's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and discounted dividend to gain insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. And in conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Newmont as an investment opportunity. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we are using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green mean a 5% deduction, and bright green mean a 10% deduction from our margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green mean a 5% deduction. The first metrics that we'll be looking at are the margin and EBIT growth. As we can see, the EBIT has actually gone down over the years, going from almost $2 billion in 2013 to $1.6 billion in 2022. The average EBIT growth though is still 5.5%, seeing as they had a lot of down years but also up years. So it averages out to an average of 5.5%, which looking at our scale is no change in the margin of safety on this metric. The margin has also gone down over the years, going from 23% in 2013 to almost 14% in 2023. The average margin decline during this period has been sitting at 1.6%, which is a 5% increase in the margin of safety. The next metric that we'll be looking at are the dividend growth and the payout ratio. The dividends have gone up over the years, come from $1.24 a share in 2013 to $1.76 a share in 2023, with a massive drop going from 2014 to 2017. This is an average dividend growth sitting at 29%, which is way past the bright green part of our scale, and gaining a 10% deduction in a margin of safety. This dividend is supported by a payout ratio that is currently sitting at 78%. And looking at our scale, that's no change in the margin of safety on this metric. And the final 2 ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And as we already previously mentioned, for Newmont this is looking very solid, as they only have a debt to EBITDA ratio of 119%, which is in the green part of our scale, indicating a 5% deduction in the margin of safety. The return on invested capital for Newmont is sitting at 11%, which, looking at our scale, is in the orange part, which means no change in the margin of safety on this metric. Looking pretty good so far for Newmont, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. We've imported the free cash flow numbers of Newmont going from 2014 to 2022. Their annual free cash flow growth during this period has been sitting at almost 37%. And I'm projecting their future free cash flow to grow by 12% annually for the next 10 years, and with this percentage we'll determine the future free cash flow for Newmont, and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 9%. And this gives us a sum of free cash flow of $33.1 billion. And to get to our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of just under $31 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $38.72, which is an upside of 9.5%. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of Newmont going from 2019 to 2023. Their average growth in their dividends during this period has been sitting at over 47%, but I'm projecting all of their future dividends to grow by 5%, which is of course a more conservative number, as some periods will be better than the others, and I feel like this number averages it out. I will once again be using a discount rate of 9% in this valuation, leaving us with a dividend discount model price per share of almost $46, which is an upside of almost 30%. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. And the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years. And on average, it has been sitting at 2.85%, while the current yield is sitting at 4.33%, indicating that it's undervalued by this metric. Looking at the PE ratio, in the past 5 years, it has been sitting at 28.70, while the current PE ratio is sitting at 24.68, which is once again meaning that it's undervalued by this metric as well, giving us an intrinsic value of this model of $47.46, which is an upside of over 34%. Now that we've gone through all of our valuation models, let's go look at the final overview of our valuation next. Looking at the final overview, we've imported discounted cash flow, discounted dividend, and mean reversion theory price per share, giving us an average of $44.04. A margin of safety we've determined earlier, using a standard margin of safety of 25%, adding 5% for the margin growth, deducting it by 10% for the dividend growth, and deducting it by 5% for the debt to EBITDA, leaving us with a 15% margin of safety. Applying this margin of safety, we get a fair value of $38.30. With the current price of $35.36, we get an upside of just over 8%, indicating that per our valuation, it is currently a hold. Now, if you want to get access to the valuation models that I use in this video and all of my other videos, you can check in the description for my Patreon link, which also will give you access to our Stock Insight tool. And if there's any other companies that you would like to see me cover on this channel, please let me know as well in the comments. Thanks for watching.